Hi, this is Efrem Hoffman broadcasting live from NakedSwanTrading.com for Monday, July the 9th. I'd like to start off with the full disclaimer. What we are going to be presenting here today basically is information intelligence, and I advise everyone to read the full disclaimer on our website at NakedSwanTrading.com. It could be found by clicking on Read the Disclaimer Regarding Risks underneath the crash warning, and then inside there you should be able to actually get access to it. It's quite comprehensive, as you could see as I'm scrolling down here. So without further ado, I'd like to now focus on the topic of discussion for today's webinar, and I'm going to take you over to a chart of the corn continuous contract. Just before I continue on with the details on corn futures, what I will be discussing today is the prospects for the agricultural futures, including corn, wheat, and soybeans, as well as revisiting what we see transpiring over the next while in the equity markets. So just to discuss the agricultural commodities, it's been relentless in terms of the heat in the central United States for an extended period. Very little rain, and what has basically happened is that there has been a tremendous increase in the futures values of corn, wheat, and soybeans. So right now I'd like to focus on first the corn market, a symbol C on TradeStation, and basically what you can see here is we have had a relentless rally since early June from a low level of around 525 and 2/8 to approximately 735 and 2/8. Being the high this week so far. But one thing that you will notice on the screen here is that there are a number of upper boundaries, okay, that are in confluence. We've got this black boundary, we've got this navy boundary, we've got this teal boundary, and shortly, as we get in, into next year, we also have this yellow boundary. But the key thing to note is that the price levels of all these boundaries are in confluence between 735 and 742 as the first level, which we just recently hit and also sold off very sharply. As you could see right now, we're down 17 and 2/3 pretty quickly after knocking off of that upper level of resistance at 732 and 2/8. So it looks like most of this move for corn is done. And if there is any overshoot after a significant retracement, then you could get as high as the next level would be 768, and 729 to 790 is extreme resistance for a very long period of time, and that kind of extends well into next year. So I have to say, unless this market could somehow get above 824, it seems to me that it is more interesting to focus on, no longer focusing on the long side of this market unless there is a significant retracement. And a natural retracement in this market for such an extended move normally would be back to the high of the bar where we actually broke out of this trading range. The high of that trading range was the 622 and 4/8, which was registered on March the 23rd, 2012. We broke out on the market in the week ending June 29th with 518,405 contracts. So the number of contracts was rather significant. Still not quite as high as the number of contracts on that first thrust up back in the January 6th area to the 614. But the second time it took out that high, it had 669,000 contracts. So we didn't have as many contracts on the break, but the follow-through volume on the following week ending July 6 had total volume of about 367,000 contracts. So there was less and less volume as we're pushing up into this resistance area, and that is one of the reasons why I do believe that the market is now giving it up. Okay? Now that doesn't mean that you're not going to have a consolidation. It's going to put up a nice fight here. But really, I'd have a hard time imagining this market getting beyond, even on some kind of crazy upthrust, 768, 776. I do realize that's a significant level from 714, but considering where this market came from, there's a heck of a lot of tail risk to the downside, even in a market that seems somewhat stable. It is, like, there is a stable base, without a doubt. Like, it was building a very solid base from the 540 area, and it appears as if there's a lot of stability in the 636 area down to the 600 area, possibly even 648. And that's an area of stability that will extend right into the late summer months. So there's likely to be some tremendous buying opportunities on any pullbacks here. But again, to keep in mind that the upper end of the range where you want to be taking profit is certainly in the vicinity where we are right now. So the idea is to buy the dips and then sell the revisits of the highs. And what you should see, if this really is an important top, you should see each time it comes up, it should come up on lighter and lighter volume. I'm going to zoom in on a shorter time frame here. I'm going to go to a daily chart, so where each bar on the chart is updated on a daily basis. And what you will see here is that the market spiked up to this resistance band over here, and we also have another resistance band that sloped up, as I showed in the other chart, around like 755 area. So there's really not much left to the upside, but there definitely is a line of support along this boundary. We just recently got above this yellow boundary, but you can see as you progress into August, this yellow boundary dips down and meets up with the confluence of these other boundaries where support is. So technically, even though right now you've got a line of support, kind of between 712 and 701 going into like the next few days, getting underneath that area, especially let's say like before the 24th, if you do get underneath 692, then basically, until you're on the other side of this yellow line, you've got risk at least back down to closing this gap. That would be like pretty normal. The gap took place basically, the high value was 675. So we would close the gap, if we were to come back, say, somewhere between 675 and the close of 674. Okay? And you can see here, even the high frequencies here, yes, some of them are extending up into that resistance area. But the point is, for a move that's this overextended, it's better to just allow the market to actually just, play into that area and then potentially, buy it back on dips. And I will revisit this, in the coming weeks. But basically, what you should take home here is that this has had a run that is a bit overextended, and but at the same time, it is in a bull phase in the sense that there is tremendous support in these areas. Okay. Now I'm going to take you over to a chart of the wheat market. Okay, and what you are going to see over here is basically going back a number of months. I actually mentioned earlier in the spring that there would be a situation where we were anticipating wheat to be one of the stellar performers. Okay, and that has certainly happened. And we indicated that there would also be baseline support right in this area. So this certainly took place, and wheat being one of the favored agricultural commodities, it took everything else up with it. I wouldn't say that, they were all related to the fact that, a couple of factors. One, the weather, and two, the fact that they were technically, in either a basing pattern or in a strong area of a trend where it retraced back into stable support and then continued off. Okay, right now, wheat, unlike corn, on a relative basis, it's still very, very inexpensive relative to some of the high values that we've had. Okay, now that doesn't mean that this run-up that we have over here isn't going to have a retracement, because normal retracement values in this market would be around the 731, 725 to 706 area, okay, which is basically going back into the breakout bar. But at the same time, we also have an area, this red line and this black line has been acting as an area of resistance for the market for some period, and that area is between 828 and 946. And we got up as high as the 844 area, so we're kind of inside that zone. So my concern is that this market tries to, even if it is decides to do another leg up, there's some major overhead resistance extending into the remainder of the year in the 946, even as low as 898 to 963 area. So there is some room to the upside. I would just say that I'd just like to get in on a pullback before going there. Longer term, the 1067 area is formidable resistance, and the 1150 area. So that would be kind of like an area that would be more similar to the valuation call on corn. However, I would even think that corn is a little bit even more overvalued than wheat would be, even at the 1067 to 1150 area. So that's how much I think it's dangerous to just think that corn is just going to keep on going up forever. That's certainly not the case. However, with wheat, if I zoom into a shorter term time horizon, I'm going to take you to a daily chart on wheat, and what you're going to see over here is basically a situation where we had a nice run up into this yellow boundary, and it's now just trying to consolidate the gains. You can see the next boundary is this blue boundary, and we have confluence at that 1067 area. That's why I'm saying that's pretty formidable. Now, normal retracements, again, on the daily would be like around 725, but there is massive baseline support for a very long extended period going well into next year in that area. So every time the market comes down there, you want to be buying it, and you just got to realize that if you do decide to buy it anywhere above that area, you just got to be prepared to, to consider, adding to a position at those areas. Now, I am not recommending for people to add to those areas. Everything I'm really saying here is information intelligence, basically, that if somebody was looking at using a trading system and they wanted to find intelligent areas of where to identify where the risk is on pullbacks, this is where the risk would be. Okay? But you should certainly, consult your own trading system as well as your personal advisor to make a last call on what to do. So this is in no way advice of any kind or a recommendation to buy or sell securities or futures of any kind. And there is tremendous risk of loss in futures markets. Okay? So just to keep that in mind. Now, so that basically is what wheat looks like over here. If I could zoom in a little bit closer, I could take us into a 34-minute chart, really, really short term here, and see what it's showing. But that's just for traders looking to trade really, really in the near term here. You can see here, market is kind of rallied up over here. It retested the high on lighter volume. It's kind of formed a nice little pivot point here. We have a little gap here back to like the 800. So I'd like to see that at least fill that gap. But really, any boundaries that are sloped down act as support, any ones that are sloped up act as resistance. You got a little bit of support here at 783, but I really don't like the idea of how we have a confluence of upward sloping boundaries all between where we are currently now and the 849 area. So very, very risky. In the short term, you want to be looking at you want to be looking at buying the dips at the aforementioned levels that I mentioned. And you could see over here the only downward sloping boundary that we have is the one that's all the way down at the 608 area. There's another one here at 704. I'm not saying it's going down here. This represents the longest term technical support. But really, there's a lot of interesting stuff taking place in the 725 area, as well as the 781 area. So that's just something to keep in mind. The next market I'd like to discuss is soybeans. So I'm going to take you to a soybean chart. Let me just shift gears over here. Just bear with me a moment. So if I go to soybeans in TradeStation, that's the S symbol. And let's take it to a daily chart on soybeans. It's going to be loading up right now. Okay, so here's what you see on soybeans. We had a nice run up over here, and you could see it's running into this resistance area, which is kind of in the 1601 area, and we're kind of just selling off a little bit here. You could see there's some boundaries of support, between 1472 and 1385. So those are areas where I would, and also kind of in the middle at that 1453 area. Those are areas where if you do have a trading system that's showing, some buy signals in that area, those are areas where it makes more sense to consider, a long position in these markets, but not at this level. It's just too much risk. And it's also done quite a full extension to the upside. If the market decides to go a little higher, just let it go and let it, retrace to the downside. Now, on the other hand, if somebody does believe that this market is going to continue extending without any kind of pullback here, and they don't really care about the fact that the market, could pull back into this area, the 1380 area, then then this yellow line is going to be acting as this yellow line and blue line is going to act as long-term support. But I just would rather just buy, on dips. You could also see this black line doesn't start to bend until after the August area. So I'd be more inclined to wait until after August to consider, being long, above this area without retracements. But my concern is that, if there is an event that takes you down here, and then if the market gets underneath this area, then of course, yes, you still have tremendous support in this zone here where we started, 1265. So that's why I'd rather be a buyer in at the 1474 and the 1394, because I just see a lot of support in there and the ability for the market to make a new attempt at the high or higher values. If I go to the weekly chart on soybeans, what you will see on the longer term is that this market has pushed up to the extreme of this area here, which is like the 1613 area, a major target area for this market. It doesn't mean it can't go higher. You can see some of these high frequencies extending as high as 1672, and some of them, could go as high as like a little over 1700. But really, what you should keep in mind over here is that, I would just like, I would just rather buy the retracements. And the two major areas of support, you got 1431 on the weeklies, and then longer term, you got 1275. And then really long term, you've got, 1074. Now, it's likely going to find support, incrementally at each levels, and then retesting, those highs. Now, if this market does not pull back, then basically this purple boundary is going to act as an area of support until such time that the price gets below this purple boundary. The market is going to be, trying to push new highs. That purple boundary is 1476. So unless we get a full week trading underneath that area, this market will remain strong. So that's why I suggest that any pullbacks that you get that are into or near that area, they're likely going to continue to allow for trades that will retest the highs. Another thing to keep in mind, definitely to keep in mind, is the fact that markets that are subject to the vagaries of weather, obviously if there is some kind of major rain event coming out of left field, or say even some severe thunderstorms that pass through the area in large mass and dump enormous amounts of rain, then certainly you could get a very sharp retracement back to those areas. That's another reason to keep that in mind. There's even another reason, and that goes back to the S&P. And I'm going to take you to a chart of the S&P market right over here. And the S&P cash market, this is just a weekly chart. I'm not going into the details of what to expect, specifically for next week. That's and on a very high resolution level, that's going to be the subject of analysis for our paid and premium subscribers, where we're going to be providing high definition risk maps with very detailed commentary for actionable setups, okay, and ongoing support. But here on the S&P cash market, what we did indicate in our previous market call last week is that the rally was going to give it up as we approached the 1275 area. And what exactly happened this week? And we were referring to the S&P 500 futures market. The market rallied up to 1275 on the T and then gave it up very strongly interweek. Okay, and right now, basically, we're basically seeing that the excuse me, I just want to make sure I said that correctly. It's the 1375 area. Okay. Right now, the same areas are acting as repellents in the market. So and then the upper areas on the daily chart are into the 1385 area. So all I can say is that going into the July-August period, we get a major volatility event to the downside. In prices, and as I've indicated over the past number of weeks, the volatility index is basically trying to base out, at least in the near term. And if we start getting price movement breaking down towards the middle and to the end of the month, that could actually put a real squeeze on the longs, because if there's major liquidity to the downside, a lot of times all markets move together, so that if commodity markets are making a high into a period when the overall market starts selling off, a lot of the times all the markets start selling off together, and the assets just start breaking down and become correlated, at least in the near term. And considering the fact that a lot of the commodity markets, or I don't want to say all commodity markets, but I mean the agricultural futures, especially corn, is right up against a wall here. I would urge all to be very cautious on the long side of the market as we get into the middle and the end of July. So that represents the weekly wrap-up. I also want everyone to stay tuned with regard to our premium subscription service. As I've indicated over the past number of weeks, we said it was going to be coming out shortly, and I'd like you all to revisit this website later this week, and as I do believe that we are going to have details out about the premium service and how you can actually become part of it. And also the first 300 subscribers to the service is going to get a complimentary analysis of some additional markets that aren't usually available to our readership. So stay tuned, and I look forward to addressing everyone next week. And these are definitely going to be some interesting times ahead. Thank you all.